Alright guys, let's quickly take a look at the upcoming US PPI print due 1:30 UK time. Now, personally, I am not very excited about trading this PPI data today, and I'm going to go through the various reasons for why that is. Let's first talk about why we could potentially trade it today. Let's start there. There's only really one reason for why we would want to trade PPI today, and that is because just like what we had back in May, this month we actually have PPI coming in ahead of CPI. What we normally get is CPI coming in ahead of PPI, which means that by the time that we get PPI, we've already seen CPI, which means the markets normally tends to discount and just ignore the PPI data once we've already seen the CPI data. But like back in May, and what we have this month is we actually have PPI coming in ahead of CPI. So if we do get a really big surprise in the PPI data, it might give some participants reason to want to maybe trade this into the CPI. So if we get a huge upside surprise or a huge downside surprise, we might see some players looking to position themselves on that beat or on that miss heading into tomorrow's CPI. That's the only reason in my mind why we would want to look to trade this today. There are, however, more reasons why we would not want to trade this event today. The first reason is just looking at how the markets have reacted in recent months to the PPI data. Let's start all the way back to February, right? February saw a decent upside surprise in the PPI data, and we had an initial spike to the upside, and this is looking at the US dollar, initial spike to the upside, which the markets faded. Then moving on to March. March was the only occurrence in the last 6 months where we actually had the dollar moving in the same direction sustainably in line with the PPI surprise. It was a solid upside surprise with the data we got back in March, and the price continued to push to the upside. What did we get back in April? We had a downside surprise in the data with price moving up. May, we had a upside surprise in the data with price moving down. June, we had a mixed print with the price eventually pushing up. And in the most recent one, we had an upside surprise and price actually pushed lower. Now, there were many other things involved in these prints. We obviously had pre-positioning to deal with a lot of these cases. We had massive stretch positioning to deal with some of them. So there were reasons why the markets reacted to the beat and the miss the way that they did. The bottom line is we haven't had sustainable, solid, predictable reactions out of PPI with things like the US dollar, with things like the ES, for example, which is the first reason why I want to ignore this print today from a tradability point of view. The second reason is because, yes, even though PPI is coming up ahead of CPI, the markets knows that PPI is not a great predictor of CPI. You know, if you take a look at this chart over here, this counts the amount of times over the last 30 months when we had a beat or a miss in both the PPI measures, looking at the headline and the core, and then at the same time we had a similar beat or a similar miss in both of the CPI measures, core and headline. And you can see over the course of the last 30 months, we've only had 9 such times when we had a beat and miss across the board, followed by a beat and miss across the board for CPI. So 30% hit rate doesn't give us a good enough reason, or the market a good enough reason to want to trade any type of beat or miss we get today into tomorrow's CPI data, even though we get it today. So that's the second reason why, personally, I don't have a lot of excitement or appetite to trade this today. The third reason is that even if we were to get a massive surprise miss and a massive surprise beat, and even if it was a good predictor, which it isn't, but let's just assume for a second that it was, we've been seeing price for PPI, which is this white line and the light blue line, we've seen this diverge from CPI and PCE over the course of the last 6 and 7 months now. As PPI has climbed steadily from the start of the year, we've seen a not so steady, but at least steadier decline decline in the PCE and CPI data. So as PPI prices have pushed up, we've seen PCE and CPI data push lower. So the markets have been able to largely ignore the upside trend that we've seen develop in PPI, purely because the measures that really matter, like CPI and PCE, they've been moving lower. Arguably then, because the markets have been used to PPI moving in the upside direction, the only occurrence where we might see a massive reaction in the markets, or at least bigger than we've seen over the past couple of months, is if we were to see just a massive collapse in the PPI data, because that will start to show PPI moving in line with what we've seen in CPI and what we've seen in PCE. And that might be something that could be worth a trade. And I will discuss what type of outcome I would personally be looking at to trade, but it's going to be a very, very narrow margin to get me excited about trading it. So, disclaimer, unless I get a exceptionally bad print today or an exceptionally low print today, personally, I'm not going to trade this. I have, as always, created a trade plan, so for those of you who feel daring enough to want to trade it the normal way that we trade economic data, I have obviously given you guys the preview. But personally for me, I'm not going to trade these numbers. There's only going to be one particular outcome that I would look to trade. And even then, that outcome has some risks involved with it, which we'll touch on in a second. So let's take a look at the numbers then. First thing to keep in mind is, as we always do, when we look at a data series like this, we don't just want to look at one or two measures. We ideally want to see all of these measures surprise in the same direction. We don't want to see one or two of them coming in hot and one or two of them coming in really low. We ideally want to see a miss across the board or a beat across the board in all four measures. Now, what type of numbers are we looking for to potentially surprise? Now, again, even though I think these would be big surprises, these will not be numbers that I would personally be trading today. There's only going to be one particular outcome, and again, I'll go through that in a second. So what type of numbers do I think can surprise? On the headline, we know that the markets are expecting it to drift down from 2.6 to 2.3. So anything below 2.6 will already be below the prior. But there I'm looking for a punchier move. In terms of a miss, I think 2% or lower would be a good trigger. Why? Because 2% is a clear outlier for the markets. Yes, it's not below the low because the low is 2%. But it's only two participants out of the whole basket that's even looking for a number that low. So at 2%, you're already surprising as an outlier. And at 2%, we smack bang on the Fed's 2% target, right? So that is something that could be seen as a dovish outcome. In terms of a hawkish one, let's keep it simple. The prior was 2.6. I don't think we need to see it necessarily accelerate because at 2.6, we're already above the market's maximum. But as a bare minimum, you want to see it stay at 2.6 or higher. I think that'll be a hawkish surprise for the markets, especially with them already expecting this to drift down to 2.3. So if we get 2.6 showing us no disinflation at all, that could be seen as hawkish. What about PPI month-over-month headline? Now, this one, minimum for as a big miss, as a dovish outcome, negative 0.1. Why? Obviously, it's the outlier. It's only two participants that's been looking for a number that's below zero, a contraction. It'll be below zero, which is a big shock in itself. It is at the market's minimum, and it's a clear outlier in terms of the distribution. So I think that'll be a big surprise for markets as well. In terms of the beat, again, let's keep it simple. The prior for this was 0.2, so anything above that will already be above the prior. But they will be looking for that outlier print. 3, there's a little bit too many participants for my liking that's looking for 3 already. So 4, even though it is the max, even though it's not going to be above the max, it's a clear outlier here. So I think 0.4 or higher should be able to do the trick. In terms of core year over year, let me just quickly open that up. Core year over year, what we're looking for a miss or a dovish outcome, 2.5, we can see it's a clear outlier. Yes, it's not below the minimum. But remember, the prior for this was 3%. So if we get 2.5 or lower, let's just say we get 2.5, that'll be a 0.5% move lower in that core PPI number. And we're getting very, very close back down towards that 2% target for the Fed as well. So 2.5, I think, should be able to do the trick. And in terms of a beat, again, let's keep it simple. The prior was 3%. We'll be looking for 3%. That is above the max and obviously in line with the prior, showing us no disinflation versus the market's expectations of a sizable 0.3% drop. And then in terms of core month over month, they will be looking for a number that's flat at 0. Why? It's the clear outlier. So yes, it's not below the minimum, but at 0, it's already going to surprise everybody apart from one, which was UBS. And I mean, if we get negative, if we get a contraction, that'll obviously be a much better miss to look for. But at 0, I think that should be enough. It'll show a big deceleration from the prior. I mean, the prior was 0.4 If we come in at 0, that's a real big chunky move to the downside for the month of a month. In terms of a beat, again, let's keep it simple. The prior was 0.4. We want to see it in line with that, which will also put us way above the market's max, and obviously, like we said, in line with the prior number. So as a normal type of print, these would be considered pretty strong deviations, right? And if we do get these pretty strong deviations, what we would expect to see in a market reaction today would be cyclical reactions for the dollar and yields, meaning if it's a dovish outcome, we expect dollar and yields lower. If it's a hawkish outcome, we expect dollar and yields higher. In terms of S&P and gold, we expect the opposite. If it's a dovish outcome, we expect upside. If it's a hawkish outcome, we expect downside. Remember, when it comes to growth and labor data, there we are seeing equities trade more cyclical, right? When it comes to inflation data, we would expect it to still trade more counter-cyclical to the data, meaning bad numbers or low numbers should be good, good numbers should be bad. In terms of possible trades here, again, now this is for those who feel daring enough to trade it. Again, I'm not going to trade these numbers myself, just don't have enough confidence to do so today. But trades that I think could work on either side, if it's a massive dovish outcome or hawkish dovish outcome, ES long, ES short, keep it very, very simple. In terms of numbers there to look for, let's just quickly get there. In terms of numbers, implied volatility low comes in right on top of that 52.82 level. That seems like a decent magnet to aim for. And the implied vol high comes in very close to 5,400, as well as these two prior bottoms going back to the 31st of July and the 25th. So that seems like very obvious magnets to aim for to the up and to the downside in terms of ES. Other markets to choose here on the dovish side, I mean, dollar yen short could be good. Why? Because you would expect both the dollar and yields to push lower. If yields push lower, we normally expect that to be more positive for the likes of the yen. And, from a yen point of view, we are getting to levels now where I would expect some yen short, yen pair short players would be looking to, at some of these levels, want to start getting back into shorts. We've been slamming up against that 148 psychological level. We haven't been able to break through there. So if we get a very decent miss, it might be enough for the markets to just break through that short-term support and potentially look for a move back down towards, let's say, 144. Maybe if it's big enough, maybe 142 to the downside. But again, like I said, it's on those numbers. If it was CPI, I would aim for that. If it's PPI, probably not, right? In terms of other markets, dollar CAD short could be good. Why? Because we've got massive stretch short positioning in the CAD right now. In terms of dollar CAD, we had a big rollover in this pair as well. And we're currently struggling to break back above that 137.60 level. So aiming for a move back down towards 137 flat could be on the cards, and then potentially move back down towards 136.60, which should be, if I eyeball this, the implied vol second standard deviation low. Let's see. I mean, look at that. Comes in very close to that, so that gives us nice confluence for something like that as well. Apart from that, Kiwi dollar long, if you feel daring, if you think like me that the RBNZ has a greater probability to hold rates instead of cut them, then potentially upside in the Kiwi. But this one is a little bit more risky, guys, because the Kiwi, the RBNZ, they could surprise with a cut tomorrow. At least surprise, let me rephrase that. They could surprise me with a cut tomorrow, and that could see the Kiwi push lower. So that one's a little bit more risky, I would say, but it is possible. Obviously, if we do get a dovish reaction, you would expect equities to do okay, and that should be supportive for the high betas. In terms of the hawkish scenarios, we looked at the ES. The other ones could be Aussie dollar short, and just to keep it simple, dollar index longs. If it's a really, really solid print, I would feel more comfortable shorting the Aussie than the Kiwi at this stage, purely from, firstly, positioning point of view. Second, the labor data for Australia only comes up on Thursday, so we've got some time to play with. We've moved into a pretty key level of resistance here around that 65.9, let's just call it 66 psychological level. Massive level of prior resistance here. That could potentially create a move back down towards 65.80, which comes in, or 65.50, which is the implied volatility low for the day. Maybe a move back down towards 65 flat could be on the cards as well. But again, we are talking about PPI data. It's not CPI. So probably too far for a PPI move, but that'll be the next key level to aim for sure. And like I say, dollar index is probably the easiest way to go about it. If you have access to the dollar index, I think trading it up or trading it down on a huge beat or a huge miss would that makes sense for a possible trade. We've got nice confluence there on the upside with that 103.60. The prior low is going back to the 18th of July. It's the implied volatility high. And we've got the low coming in at about 102.60. So we've got some really solid levels to aim for, I think, to the up and to the downside for the dollar index. Now, like I said, I'm not going to trade these types of outcomes. For me, this is going to be too, for the reasons I explained, I just don't think it's going to be high conviction. What I would like to trade, though, is if we were to see headline inflation print back below 2%, so if we see year over year dipping into, let's say, 1.9, 1.8, and we were to see core inflation getting to 2%, if we see like a whole, 1% shaved off the core PPI number, so this below 2% and this, let's say, at 2%, that would potentially be something that I would look to trade. And that will be the only outcome, because that'll show us that the only two inflation measures that's been pushing up is now back down towards the 2% target. That'll seriously open up, more reasons for the Fed to pull the trigger a little bit sooner. Or what I mean with sooner is in September, obviously. So that'll be a possible outcome that I would look to trade. And on that front, I'm going to keep it simple. I'll be looking for dollar downside initially and equity upside initially. The reason why I say initially is that if we do get a big CPI, or let me say, a PPI surprise like that to the downside, it could actually start to stoke some deflation concerns in the markets. Now, deflation is when you have both growth and inflation / labor as well, slowing all at the same time. Now, in those environments, that's actually negative environments for equities and positive environment for the US dollar, because that's more like a recessionary type of outcome. So the way that I would look to trade something like that, a miss like that, is just as a short term, and I mean very short term initial scalp, just trading the initial pop up in equities, the initial push down in the dollar. But I'll be looking to take profit much quicker than usual, because there's the risk that if we get a bad number like that, the market starts screaming recession, ringing the recession bell again, saying, hey, this is looking dangerously like deflation. That's not great for equities, and that's normally positive for the US dollar. So we could even play some 4D chase and maybe look to fade those types of moves on a massive miss like that. But let's just be patient for now. If it's that type of move, that type of miss, I'll be looking for very short-term equity up, dollar downside trades, but I'll be looking to take profit very quickly, very, very quickly on those types of trades, and then looking for possible reversals, maybe news reversals, on those type. If we start seeing some deflation concerns brewing in the markets as a result of that. So bottom line, not something that I'm very keen on trading today. Just to recap, the recent occurrences just hasn't been solid enough to give me conviction. It's just not a good enough predictor of where CPI will land. And the other thing we've been looking at is that, the markets haven't paid attention to this, because the measures that really matter, like CPI and PCE, they've been moving in the right direction. So if this pushes up again, the market should theoretically be able to discount that fairly quickly. So that's just a preview for the PPI data. As always, any questions, don't hesitate to let me know.